Let me tell you about a formula that I've used for decades to build retirement portfolios that actually work. And here's what's crazy about it. Almost nobody uses it. Almost nobody even knows about it. People come to me, they ask me how to invest for retirement, and I tell them this formula and they say thank you, and then they completely ignore it. They go off and do something much more complicated. They hire a financial advisor, they buy a bunch of different mutual funds, they try to pick stocks. They do all these things that make them feel like they're doing something smart, but they're actually just adding complexity and costs and risk to their retirement, and most of them end up with worse results than if they just followed the simple formula I'm about to share with you. Here's what troubles me most about retirement investing today. People have been sold on the idea that more is better. More diversification, more asset classes, more active management, more complexity. Financial advisors are paid to convince you that you need them, that you need their expertise, that you need their complicated strategies, but the truth is the opposite. The best retirement investing approach is simple, boring, mechanical, something a computer could execute, and that's exactly why people ignore it, because it doesn't feel smart. It doesn't feel like you're doing anything. You're just buying and holding. You're not making sophisticated decisions. You're not timing the market. You're not picking winning stocks. You're just doing the boring thing every single month for decades, and that boring thing is what builds wealth. I'm going to share with you today the exact formula I would use if I was starting over at retirement. This isn't theoretical. This isn't something I came up with because it sounds good. This is based on 70 years of investing experience, and this is what actually works. And I'm going to be very specific about it so you can understand not just what to do, but why it works and how to implement it. The foundation of retirement investing is something I call the four-pillar approach. And here's the beautiful thing about it. Almost everything you need to know about retirement investing can be distilled into four basic principles, four pillars. Master these four principles, and you've mastered retirement investing. And here they are. First, you need to accumulate capital before retirement. Second, you need to transition to income generation as you approach retirement. Third, you need to preserve capital during retirement so you don't run out of money. Fourth, you need to maintain purchasing power so inflation doesn't destroy your retirement. That's it. Four pillars. Master these and you're done. Let me explain what I mean by each one. First, accumulation. This is what you do from the time you start working until about 5 to 10 years before retirement. Your goal is to accumulate as much capital as possible. This means investing aggressively, maximizing your tax-advantaged accounts, taking advantage of employer matches, and reinvesting all dividends. This phase can last 20, 30, or 40 years depending on when you start. The power of compound interest during this phase is extraordinary. A person who invests $1,000 per month for 40 years in a portfolio earning 10% per year accumulates over $5.1 million. That's not 7%, that's 10%. But even at 7%, which is a more conservative estimate, that person accumulates over $2.2 million. That's life-changing money, and it came from simple, consistent, boring investing. The second pillar is transition. This is 5 to 10 years before retirement. Your goal during this phase is to slowly shift from a growth-oriented portfolio to a more income and full stability-oriented portfolio. You're not selling everything at once. You're gradually making the transition. You're increasing bonds, you're increasing dividend-paying stocks, you're increasing income-generating assets. This transition phase is critical because it allows your portfolio to adjust slowly rather than making a sudden shock to the system. If you wait until the day you retire to shift your portfolio and the market crashes right when you retire, you're in trouble. But if you've been gradually transitioning over 5 to 10 years, the transition is already mostly done. The third pillar is preservation. This is retirement itself. Your goal is to preserve your capital while generating enough income to live on. This is where most people get it wrong. They think preservation means owning only bonds and cash. But that's backwards. Your portfolio still needs to grow during retirement because you're going to live for 30 years or more. And over 30 years, inflation will erode your purchasing power significantly if your portfolio doesn't grow. So preservation doesn't mean zero growth. It means moderate growth. It means generating enough income to cover your living expenses while still maintaining enough growth to fight inflation. The fourth pillar is inflation protection. This is the part that almost everybody neglects. They focus on the first three pillars and they forget about inflation, and that's a mistake. Inflation is silent. Inflation is deadly. Inflation will destroy your retirement if you're not intentional about fighting it. This is why you need some stocks in your portfolio even in retirement. This is why you need dividend-paying stocks that grow their dividends. This is why you need real assets. This is why you need inflation-protected bonds. You need things in your portfolio that actually go up in value when inflation happens. Things that maintain or increase your purchasing power. Now let me share the specific retirement investing formula that I use. This formula has worked through multiple recessions, through inflation spikes, through financial crises. It's proven, it works. Here it is, 50% in dividend growth stocks. These are high-quality companies that pay dividends and grow them every year. Examples include Procter & Gamble, Johnson & Johnson, Coca-Cola, Duke Energy, AT&T, 25% in bonds, investment-grade bonds with a ladder of maturities so that some bonds mature every year, 15% in real assets. This could be real estate investment trusts, inflation-protected securities, or actual real estate if you own it. 10% in cash and alternatives, money market funds, short-term bonds, or other liquid assets. This allocation is specifically designed for retirement. It's not aggressive, it's not conservative, it's balanced in a way that generates income while maintaining growth. Let me walk you through how this allocation performs in different market environments. Let's say the stock market has a normal year and goes up 10%. Your dividend growth stocks go up about 10%. Your bonds go up about 1 to 2%. Your real assets go up about 3 to 5%. Your cash stays flat. Your overall portfolio goes up about 5 to 6%. That's excellent for a retirement portfolio. You're beating inflation, you're generating income, and you're growing capital. Now let's say the stock market has a bad year and goes down 20%. Your dividend growth stocks go down about 20%, but they're still paying you dividends. So your actual loss might be only 17% because of the dividend income. Your bonds go up about 1 to 3% because investors are fleeing stocks and moving to safety. Your real assets might stay flat or go down slightly. Your cash stays flat. Your overall portfolio goes down about 5 to 7%. That's much better than the stock market's 20% decline. You've cushioned the blow through diversification. And importantly, your portfolio is still generating income. You're still collecting dividends. You're still collecting bond interest. You're still getting paid even though prices are down. Now let's say we get inflation. Inflation is running at 5%. Your dividend growth stocks are probably raising dividends by 5 to 7% per year. You're beating inflation. Your bonds might be up 1 to 2%. So you're losing purchasing power on that portion. But bonds are only 25% of your portfolio. Your real assets are probably up 3 to 5%, maybe more. Your cash is losing purchasing power. But again, cash is only 10% of your portfolio. Overall, your portfolio is probably growing by 2 to 3% per year in real terms, beating inflation. That's what you want. Let me get very specific about what stocks I would own in the 50% equity allocation. I would own a mix of individual dividend growth stocks and a diversified, dividend-focused index fund. The individual stocks might include Procter & Gamble, Johnson & Johnson, Coca-Cola, Duke Energy, AT&T, Realty Income, Verizon. These are companies with 20, 30, 40, 50, 60, even 70 years of consecutive dividend increases. These are the ultimate safe stocks. Then I would complement this with a diversified dividend index fund that owns hundreds of dividend-paying stocks. This gives me diversification while maintaining the dividend focus. Now let me get specific about bonds. I would not recommend buying 30-year bonds. I would recommend building a bond ladder. This means buying bonds with different maturity dates. Some bonds that mature in 1 year, some in 2 years, some in 3 years, up to maybe 10 years out. As each bond matures, the principal comes back to you. You can spend it or reinvest it. This creates a natural cash flow. Every year you have bonds maturing. This is called a bond ladder, and it's the smartest way to own bonds in retirement. For real assets, I would recommend a mix. Maybe allocate half to real estate investment trusts through a diversified REIT index fund. Maybe allocate half to Treasury inflation protected securities or I bonds. This gives you inflation protection from multiple angles. REITs benefit from inflation because rents go up. TIPS and I bonds explicitly protect against inflation by adjusting for it. For cash, I would recommend keeping 1 to 2 years of spending needs in cash or money market funds. If you need $50,000 per year, keep $50,000 to $100,000 in cash. This is your emergency fund. This is what you use to cover living expenses during market downturns instead of selling stocks at bad prices. Now let me talk about how to actually transition from accumulation to retirement using this formula. Let's say you're currently in full accumulation mode. You might have something like 80% stocks and 20% bonds. Your goal now is to shift gradually to the 50-25, 15-10 allocation I've described. You don't make this shift all at once. You make it slowly over 5 to 10 years. Year 1, you shift your allocation to 68% stocks, 24% bonds, 5% real assets, 3% cash. Year 2, you shift to 62% stocks, 25% bonds, 8% real assets, 5% cash. You keep gradually shifting until you reach your target allocation of 50% stocks, 25% bonds, 15% real assets, 10% cash. During this transition phase, you're not selling stocks at the top and buying bonds at the bottom. You're rebalancing gradually. You're using new contributions to buy bonds. You're using dividends to buy bonds. You're gradually moving the needle. By the time you actually retire, your portfolio is already positioned correctly. You're not making a sudden shock to the system. Now let me talk about the income generation piece of this, because this is critical and most people get it wrong. When you're in accumulation, you reinvest all your dividends, and when you transition to retirement, you start living off some of your income. Let me give you the math. A 50% stock allocation with an average dividend yield of 3% generates 1.5% dividend income. 25% in bonds yielding 3 to 4% generates about 1% bond income. 15% in real assets yielding 4 to 5% generates about 0.5% income. Overall, your portfolio is generating about 3% per year in income. If you have $1 million, that's $30,000 per year in passive income. That's meaningful. Now, here's the critical part. This 3% income should cover 70 to 80% of your living expenses. If you need $40,000 per year to live, $30,000 of that comes from dividend and interest income. The remaining $10,000 comes from either your required minimum distributions from retirement accounts or from selling shares in your taxable accounts. This is important because it means you're not forced to sell stocks to generate cash flow. You're living off income first. You're only selling as a last resort. Let me talk about tax efficiency because this matters enormously in retirement. Tax-efficient withdrawal sequencing is critical. You want to spend money in a specific order to minimize taxes. First, you spend money from your regular taxable accounts. This is money that's already been taxed. Second, you take required minimum distributions from traditional retirement accounts. These are taxed as ordinary income. Third, you spend money from Roth retirement accounts if you have them. These withdrawals are not taxed. This sequencing minimizes your overall tax burden. I also want to talk about something specific to retirement accounts. If you're over 73 in the United States, you have required minimum distributions from traditional IRAs. This is actually an opportunity. These distributions are forced withdrawals. You have to take them, but you can use them strategically. You can time them. You can use them to rebalance your portfolio. If your stock allocation has gone up and you need to rebalance back down, you can take your required minimum distribution from your stock holdings. This forces you to sell high. Now let me talk about the psychological piece of retirement investing, because this is where most people struggle. You've worked your entire life, you've accumulated capital, now you need to spend it. And psychologically, that's hard for a lot of people. They've spent decades building, they've spent decades not touching their investments, and now they're supposed to spend them. That goes against decades of conditioning. But here's what I want to tell you. If you have enough money to retire, you're allowed to spend it. You don't have to leave everything to your kids. You don't have to die with the biggest portfolio. You've earned the right to enjoy your retirement, spend your money, use it. Travel, enjoy experiences, give to causes you care about, but do it systematically. Don't spend randomly. Have a plan. Here's what I recommend. Calculate how much you need to spend per year. This should be based on your lifestyle and your needs, not on some arbitrary rule like the 4% rule. The 4% rule is a rough guideline, but it's not gospel. Some people can safely spend 5%. Some people need to spend only 3%. It depends on your situation. Once you've calculated your spending, make sure your portfolio can generate that income. If it can't, you need to adjust either your spending or your portfolio. Now, let me talk about market crashes and how to handle them in retirement. This is where the formula I've described really shines. When the stock market crashes, your dividend growth stocks might decline 20 or 30% in value, but you're still getting paid dividends. The dividends might even increase if the companies are maintaining or growing them. Meanwhile, your bonds go up because investors flee stocks, your real assets might stay stable or go up. Your cash is there as a buffer, your overall portfolio is down maybe 5 to 7%. That's manageable. That's not a disaster. Here's what you do during a market crash. You don't panic. You don't sell. You continue to collect your dividends. You continue to collect your bond interest. You live off your income and your cash buffer. You don't touch your stocks. And when the market recovers, which it always does, your stocks are back to where they were and then some. Meanwhile, you've weathered the storm without being forced to sell at bad prices. Let me give you a specific example. The 2008 financial crisis was devastating. The stock market declined 57% from peak to trough. That's one of the worst crashes in history. But here's what happened to a retirement portfolio with the allocation I've described. Stocks declined 57%. Bonds actually went up 8% because investors sought safety. Real assets declined about 30%. Overall, the portfolio declined about 20%. That's bad, but it's much better than the 57% decline in stocks. And importantly, the portfolio is still generating income. A person who was receiving dividend income and bond interest was still getting paid even though the market was crashing. They could live off that income without selling anything. And by 2013, just 5 years later, the portfolio had recovered to new highs. Those who held through the crisis made fortunes. Those who sold locked in losses. Now let me talk about something that I think is critical, the importance of having a written plan. A lot of people retire without a written plan. They know roughly how much money they have. They know roughly how much they need to spend, but they don't have a specific plan written down. I would strongly recommend creating a detailed retirement plan and write down your goals. Write down your projected spending for each year. Write down how much you think you'll receive from Social Security and pensions. Write down your investment allocation. Write down your rebalancing schedule. Write down your withdrawal strategy. Write it all down. Why does writing it down matter? Because when the market crashes and you're scared, you can look at your written plan and remind yourself that you've already thought about this. You've already decided how to handle crashes. You don't need to make emotional decisions. You just need to follow the plan. This is incredibly powerful. A written plan is an emotional anchor during difficult times. I also want to talk about something specific, healthcare costs in retirement. This is something that a lot of people underestimate. Medicare covers a lot, but not everything. Long-term care is not covered. Dental is not fully covered. Vision is not fully covered. Hearing aids are not covered. A serious illness could require significant out-of-pocket spending. I would recommend setting aside additional capital specifically for healthcare beyond your regular retirement spending, maybe $50,000 to $150,000 depending on your age and health status. This is insurance. It's uncomfortable to think about, but the alternative is financial disaster. Let me also talk about estate planning. Most people over 70 don't have an updated estate plan. They have an old will. They haven't updated beneficiaries. They haven't thought about what happens if they become incapacitated. I would strongly recommend working with an estate attorney to update your documents. Make sure your will is current. Make sure your beneficiary designations are correct. Make sure you have a power of attorney designated. Make sure you have a healthcare proxy designated. Make sure you have a living will. This is not just for peace of mind. This is for protecting your family. Now, let me talk about something specific about dividend growth stocks in retirement, because I think this is the most underutilized tool for retirement investing. Most people think of dividend stocks as boring, as low growth, as something for retirees who need income. But actually, dividend growth stocks are perfect for retirement because they provide both income and growth. A dividend growth stock pays you income every quarter. That income goes into your pocket, but the stock also appreciates over time. The company increases its dividends every year. As the dividend grows, your yield increases. Over time, the dividend yield on your original investment can double or triple. Let me give you an example. Procter & Gamble currently yields about 2.5%, but the company has been increasing its dividend for over 60 years. An investor who bought Procter & Gamble 20 years ago got a 2.5% yield on their original investment, but because the company has been raising the dividend every year, that investor now gets a 4 to 4.5% yield on their original investment. They're being paid more than double what they were paid 20 years ago on the same investment. That's how you beat inflation, not through capital appreciation, through growing dividends. This is why I love dividend growth stocks for retirement. You're not dependent on capital appreciation. You're not dependent on selling your stocks at the right time. You just collect your dividends, let them grow. And over time, your income grows. That's beautiful. Now, let me talk about the power of staying invested. I know I keep harping on this, but it's so important. A lot of people think that retirement means getting out of the stock market, and they think you should be mostly in bonds and cash, but that's wrong. Your retirement is potentially 30 or 40 years long. You still need growth. You still need inflation protection. You still need stocks. Staying invested is critical. Let me give you some statistics. If someone had invested in the S&P 500 at the worst possible time, right before the 1987 crash, and held for 20 years through multiple recessions and crises, they would have made over 300% on their money. 300%, even buying at the absolute worst time and holding through everything. You make money. That's the power of staying invested. Now, let me talk about required minimum distributions specifically, because this is something that confuses a lot of retirees. If you're over 73 and you have a traditional IRA, the government requires you to take distributions. These are called required minimum distributions, or RMDs. The amount increases every year as you get older. These distributions are taxed as ordinary income. But here's the thing. You can be strategic about it. You can use your RMDs to manage your portfolio. You can take RMDs from certain investments to rebalance. You can use RMDs to fund charitable giving. You have options. Let me also talk about Roth conversions. A Roth conversion is when you take money from a traditional IRA and convert it to a Roth IRA. You pay taxes on the converted amount in that year, but from then on, all the growth is tax-free and you can withdraw it tax-free in retirement. This is especially valuable if you're in a lower tax bracket in early retirement before you're forced to take large RMDs. A Roth conversion now can save you tens of thousands of dollars in taxes over your retirement. Talk to a tax professional about whether Roth conversions make sense for you. Now, let me talk about something practical. How often should you review your retirement plan? I would recommend reviewing it once per year, maybe on your birthday or at the beginning of the year. Look at how your portfolio performed. Look at your spending. Look at whether you're on track. Make any adjustments that are necessary, but don't review it constantly. Don't check your portfolio every day or every week. That will drive you crazy. Once a year is enough. Let me also talk about something about Social Security. Many people start taking Social Security as soon as they can at 62, but if you can afford to delay, you should. For every year you delay between 62 and 70, your benefit increases by about 8%. If you delay from 62 to 70, your benefit is about 70% higher over a 30-year retirement. That extra income makes an enormous difference. If you have the financial resources to delay Social Security, do it. Now, let me talk about the specific companies I would own in the dividend growth stock portion of a retirement portfolio. I've mentioned some before, but let me be very specific. Procter & Gamble has increased its dividend for over 60 years straight. The current yield is about 2.5 to 3%. The company is expected to increase the dividend by about 5 to 7% per year going forward. That's beating inflation. Johnson & Johnson has increased its dividend for over 60 years. The current yield is about 2.5 to 3%. The company is expected to increase the dividend by about 5 to 6% per year. Coca-Cola has increased its dividend for over 60 years. The current yield is about 3%. The company is expected to increase the dividend by about 6 to 8% per year. Duke Energy has increased its dividend for over 35 years. The current yield is about 4 to 4.5%. The company is expected to increase the dividend by about 4 to 5% per year. AT&T has increased its dividend for over 37 years. The current yield is about 7 to 8%. The company is expected to increase the dividend by about 2 to 3% per year. Colgate-Palmolive has increased its dividend for over 60 years. The current yield is about 2.5%. The company is expected to increase the dividend by about 4 to 6% per year. These 6 companies combined give you a portfolio of dividend growth stocks with yields around 3 to 4% and dividend growth rates of 4 to 6% per year. Let me also talk about how to diversify beyond just individual stocks. You could also buy a dividend-focused index fund or ETF that owns hundreds of dividend-paying stocks. This gives you diversification while maintaining the dividend focus. Examples include the Schwab U.S. Dividend Equity ETF or the Vanguard Dividend Appreciation ETF. These funds provide exposure to dividend-paying companies across all sectors. Now let me talk about something about bonds that I think is important. A lot of people avoid bonds because bonds generate low income, and they see a 2 or 3% yield and they think, why bother? But bonds are not about yield. Bonds are about stability and diversification. Bonds decline much less than stocks in a market crash. Bonds actually go up when stocks go down because investors seek safety. Bonds provide a cushion to your portfolio. That cushion is worth money. It's worth the lower yield. I also want to talk about inflation-protected bonds specifically. Treasury inflation-protected securities, or TIPS, are bonds that adjust for inflation. If you buy a $10,000 TIPS bond and inflation averages 3% per year for 10 years, when the bond matures, you get back about $13,400. That's guaranteed. There's no inflation risk. TIPS currently yield around 1 to 3% above inflation. That's real return. That's beating inflation. If you're worried about inflation, TIPS should be part of your bond allocation. Let me also talk about something about interest rates and bonds. A lot of people worry about rising interest rates and wonder if they should own bonds. But here's the thing. If you're holding bonds to maturity, interest rates don't matter. You're going to get your principal back. But if you're buying bonds and selling them before maturity, rising interest rates hurt you because bond prices decline when rates rise. So the question is, are you holding bonds to maturity? If yes, rates don't matter. If you're trading bonds, rates matter a lot. I recommend holding bonds to maturity through a bond ladder. That way you don't have to worry about rates. Now let me talk about the mechanics of implementing this retirement formula. First, if you're not yet retired, you should start the transition now. Don't wait until the day you retire. Start gradually shifting your allocation from growth-oriented to income and stability-oriented. Use new contributions to buy bonds and real assets. Use dividends to buy bonds. Gradually make the shift over 5 to 10 years. Second, open a brokerage account if you don't have one. Set up accounts for individual stocks, bond ladder, REIT holdings, and cash. You can do all this at one broker or use multiple brokers, whatever you prefer. Third, decide on your specific allocation. 50% dividend growth stocks, 25% bonds, 15% real assets, 10% cash. Decide what this looks like in dollar terms. If you have $1 million, that's $500,000 in stocks, $250,000 in bonds, $150,000 in real assets, $100,000 in cash. Fourth, build your portfolio. Buy the dividend stocks, construct your bond ladder, buy the real assets, move the cash to a money market fund. Don't try to do this all at once. You can do it over several months. Use new contributions and rebalancing opportunities. Fifth, set up your income flow. Arrange for dividends and interest to be paid to your checking account or to be reinvested. Arrange for bond maturities to come due in your account. This creates your income stream. Sixth, calculate your withdrawal rate. If your portfolio generates 3% income and you need that plus some principal, how much can you safely withdraw? Run the numbers, make sure you're sustainable. Seventh, set up your rebalancing. Once per year, rebalance your portfolio back to your target allocation. If stocks have gone up and now represent 55% instead of 50%, sell some stocks and buy bonds to get back to 50%. Eighth, monitor and adjust. Once per year, review your plan, look at your spending, look at your portfolio performance, make any adjustments that are necessary, but don't obsess over it. Don't check constantly. Let me also talk about something about withdrawal rates. The 4% rule says you can withdraw 4% of your initial portfolio in the first year of retirement and then adjust that withdrawal for inflation every year. This rule has worked historically, but it's not perfect. Some people need to withdraw more. Some people can safely withdraw less. It depends on your portfolio composition, your life expectancy, your spending needs, and other factors. I would recommend running some retirement projection software or working with a financial advisor to determine your safe withdrawal rate. Now let me talk about the biggest mistakes I see people make in retirement investing. First, they retire without a plan. They don't know if they have enough. They don't have a withdrawal strategy. They wing it. That's dangerous. Have a plan. Second, they try to be too aggressive. They think retirement means getting riskier in hopes of making more money. But retirement is not the time for aggressive risk-taking. Third, they try to be too conservative. They think retirement means owning only bonds and cash. They're so afraid of losing money that they guarantee they'll lose purchasing power to inflation. Fourth, they chase yield. They buy stocks with high dividend yields that are yielding high specifically because something is wrong. A stock yielding 8% is yielding that for a reason. Usually it's because the dividend is at risk of being cut. Fifth, they ignore taxes. They make withdrawals without thinking about tax efficiency. They waste money on unnecessary taxes. Sixth, they don't rebalance. They let their portfolio drift. They get too concentrated in whatever is done well. Seventh, they panic during crashes. They sell at the worst times. They lock in losses. They miss the recovery. Avoid these mistakes. Have a plan. Maintain appropriate risk. Maintain diversification. Be tax efficient. Rebalance regularly. Stay disciplined during crashes. Now let me give you one final piece of advice. The most important thing in retirement investing is having the discipline to stick to your plan. The plan itself is important, but execution is more important. A good plan executed perfectly beats a great plan executed poorly. So commit to your plan. Write it down, review it annually, make adjustments only when necessary, but mostly stick to it. If you follow the formula I've outlined, if you accumulate during your working years, transition gradually as you approach retirement, preserve your capital during retirement, and maintain purchasing power through inflation protection, you will have a successful retirement. You will not run out of money. You will not be stressed about finances. You will be able to enjoy your retirement. Here's what I want you to do right now if you're approaching retirement or already retired. First, calculate your total portfolio value. Write it down. Second, calculate how much income you need annually to live. Write it down. Third, calculate how much income your current portfolio generates. Dividends, interest, everything. Write it down. Fourth, compare the last two numbers. Are you generating enough income? If not, what's your plan? Fifth, look at your current allocation. Is it aligned with the formula I've described? If not, start making adjustments. Sixth, create a written retirement plan. Write down your goals, your spending, your investment allocation, your rebalancing plan, your withdrawal strategy. Seventh, set up annual reviews of your plan. once per year, check in and make sure everything is still on track. If you do these things, you will be in excellent shape. You will have a retirement that's secure, that generates income, that maintains purchasing power, and that provides peace of mind. If this content has been valuable to you, if you now understand the retirement investing formula that most people ignore, I need you to do something for me, like this video. Hit that thumbs up button. Let me know you found value in this content and subscribe to this channel right now, because I'm going to keep bringing you content about retirement investing, about building wealth, about financial planning, about income generation. New videos every single week. Don't miss a single one. Turn on notifications so you're alerted the moment I post a new video. Leave a comment below. Tell me your age. Tell me how much you've saved for retirement. Tell me how much you need to spend annually. Tell me if you're going to implement this formula. Tell me what questions you have about retirement investing. I read every comment and I respond to as many as I can. This is a community and I want to hear from you. Retirement doesn't have to be stressful. It doesn't have to be complicated. If you have a plan, if you have the right formula, if you have discipline, you can have a retirement that's successful and peaceful. You can wake up in the morning not worried about money. You can spend time with family and friends. You can pursue hobbies and interests. You can travel. You can give to causes you care about, but it all starts with having a plan and executing it. That's what separates successful retirees from those who are stressed. So create your plan, execute it, and enjoy your retirement. Thank you for watching. I'll see you in the next video.